Are you an investor or a trader? Have you ever wondered what sets them apart from each other? Today, we're delving into this intriguing topic, peeling back the layers to reveal the core differences between these two financial roles. Stay tuned as we delve into the nuances between investing and trading. And first, let's understand who an investor is. By its simplest definition, an investor is an individual or entity who allocates capital with the expectation of a future financial return. But there's more to it than just that. Investors have a unique perspective, a long-term one, to be precise. They're not interested in the quick in-and-out approach to making money. No, they're in it for the long haul. They are like the marathon runners of the financial world. They train, they prepare, they strategize, and then they run their race with patience and determination, keeping their eyes on the finish line that could be years, even decades down the road. Now, what drives their decisions? Well, they rely heavily on what's known as fundamental analysis. This involves evaluating a company's financials, its industry position, market trends, and economic indicators. They dig deep, studying balance sheets, income statements, and cash flow charts to understand the strength and potential of a business. They're looking for companies with solid foundations, promising futures, and the ability to weather economic storms. Investors are also very goal-oriented. Their primary objective? Building wealth over time. They understand that wealth creation is a process, not an event. They're not after the quick buck, but rather they're looking to grow their wealth steadily and sustainably. They consider factors like dividends, interest, and capital appreciation in their wealth accumulation strategy. But it's not just about the money. Investors also consider the impact of their investments. Some, known as impact investors, specifically seek out companies that align with their values and contribute positively to society or the environment. To sum it up, an investor is a patient, analytical, and forward-thinking individual. They're not swayed by short-term market fluctuations, but remain focused on their long-term financial goals. They take calculated risks, make informed decisions, and understand that growing wealth takes time. So, in essence, an investor takes a more strategic, long-term approach. They're the chess players of the financial world, always thinking several moves ahead. They know that in the game of investing, patience is not just a virtue, it's a strategy. Now, let's turn our attention to traders. A trader, in the world of finance, is like a skilled surfer riding the waves of the market. They don't wait for the tide to rise slowly. They harness the power of the waves, big or small, and use them to their advantage. Traders operate on a much shorter timeline than investors. While an investor might hold on to stocks for years, a trader might hold on to them for just a few minutes, hours, days, or at most, a few months. They're all about the here and now, not the distant future. Traders use what's known as technical analysis to make their decisions. This is a method of evaluating investments by analyzing statistical trends gathered from trading activity, such as price movement and volume. Unlike investors, they don't spend time delving into a company's fundamentals, like its balance sheet or the quality of its management team. Instead, they look at charts and graphs, searching for patterns and signals that the price of a stock is about to move. And here's the exciting part. Traders thrive on volatility. Volatility in the financial world refers to the rate at which the price of an asset increases or decreases for a set of returns. The more volatile the market, the more opportunities there are for traders to buy low and sell high. Or in some cases, do the reverse by shorting stocks, that is, selling stocks they don't own with the aim of buying them back at a lower price. So, you see, traders are like financial adrenaline junkies. They don't want a smooth, steady ride. They want ups and downs, twists and turns. They want action, and they're willing to take on the risk that comes with it, all in the hope of landing a big, quick profit. So, traders are more tactical, seeking to profit from short-term market movements. They're the fast-paced, quick-thinking counterparts to the more methodical, long-term investors. Both play a crucial role in the financial markets, but their strategies and goals are vastly different. Now that we have defined both investors and traders, let's compare them. Investors and traders are like two sides of the same coin, operating within the same financial markets but with distinct strategies, goals, and timeframes. To begin with, let's discuss the time horizon. Investors are akin to marathon runners, focusing on the long term. They buy assets with the intention to hold them for years, even decades, patiently waiting for their investments to appreciate over time. Conversely, traders are more like sprinters. They aim to profit from short-term price fluctuations, buying and selling assets within a matter of days, hours, or even minutes. Next, let's talk about their analysis methods. Investors generally use what's known as fundamental analysis. They dig deep into a company's financial health, its industry position, and the overall economic environment. They assess things like earnings reports, balance sheets, and industry trends, trying to determine a company's intrinsic value. Traders, on the other hand, typically use technical analysis. They study charts, patterns, and indicators to predict how prices will move in the short term. While fundamental analysis is like reading a novel, technical analysis is more akin to reading a weather report. Now let's take a look at risk tolerance. Investors, with their long-term horizon, are generally more tolerant of short-term losses. They understand that markets ebb and flow, and temporary downturns don't necessarily deter them. Traders, however, have a lower tolerance for risk. They set strict stop-loss orders to limit potential losses and take profits quickly to ensure they don't evaporate. Finally, we come to the goals of investors and traders. Investors seek to build wealth gradually, aiming for steady and consistent returns. They're not necessarily after the next big thing, but rather they seek solid performers that will grow reliably over time. Traders, conversely, are looking for quick gains. They're less interested in the long-term potential of a company and more focused on seizing profitable opportunities presented by market volatility. Let's illustrate these differences with an example. Consider Apple Inc. An investor might buy Apple shares believing in the company's long-term growth potential due to its strong brand, innovative products, and robust financials. They would hold on to these shares, weathering any short-term market volatility. A trader, however, might buy Apple shares one day, anticipating a positive earnings report the next day. Once the report is out and the price jumps, they would sell, pocketing the profit. In essence, investing and trading are two different approaches to making money in the financial markets. They differ in their time horizons, analysis methods, risk tolerance, and goals, each offering unique challenges and rewards. While both investors and traders participate in the same financial markets, they do so in very different ways. So, the question arises, which one is better, investing or trading? Well, there's no one-size-fits-all answer to this. Both investing and trading have their own sets of pros and cons. It's like choosing between a marathon and a sprint. A marathon requires endurance and long-term commitment, much like investing. On the other hand, sprinting, like trading, requires speed and agility. Investing has the advantage of compounding interest over the long term. It's a slow and steady process that can lead to substantial gains, but it requires patience and a high tolerance for market fluctuations. Trading, on the other hand, can provide quick returns. It's exciting, fast-paced, and can be highly profitable if done right. However, it's also riskier and requires a keen understanding of market trends and patterns. So how do you choose between the two? It depends on several factors. First, your financial goals. Are you saving for retirement or looking for a quick way to make money? Second, your risk tolerance. Can you handle the volatility of the stock market? Or do you prefer the relative stability of long-term investments? And third, your time commitment. Are you willing to spend hours every day monitoring the markets, or would you rather set it and forget it? Ultimately, whether you choose to be an investor or a trader depends on your personal circumstances and preferences. To sum it all up, we've journeyed through the exciting world of finance, unraveling the distinct paths of investors and traders. If you recall, we defined an investor as a long-term player, someone who meticulously researches and puts their money in assets they believe will appreciate over time. They're the marathon runners of the financial world, patient, strategic, and focused on the finish line. On the other hand, we have traders, the sprinters of finance. They are the adrenaline junkies, thriving on the thrill of buying and selling stocks, currencies, commodities, and more within short time frames, sometimes even within a day. Their goal isn't necessarily to hold on to assets, but to profit from market fluctuations. We've compared these two financial players, highlighting their differences, from investment time frames to risk tolerance. From research methods to profit goals, we've seen that investors and traders operate in distinct ways, each with their own advantages and challenges. So, which one is better? Well, that depends on your personal financial goals, risk tolerance, and investment style. There's no one-size-fits-all answer here. Whether you're an investor or a trader, remember the goal is to make informed decisions to achieve your financial objectives. Until next time, stay financially savvy.